So I'm going to introduce our first speakers. We've got Sam Smith, CEO, and Tom Hayward, CFO of finnCap. finnCap was listed just before the end of last year, 2018, and at the same time concluded a very material acquisition, a business called Cavendish, that I'm sure that the guys will talk you through. They're certainly one of the highest profile brokers in the UK marketplace, and they probably act for or certainly know a number of the companies in which you invest. And now you've got the opportunity to invest in finnCap itself. So I won't say any more, but I'll leave that to the management team, Tom Hayward, and to start us off, Sam Smith.
Good evening. I'm Sam Smith, I'm CEO at finnCap, and I've been at the finnCap Group for 21 years this year, so most of my career. So what is finnCap? Most of us people think of us as a broker, but since our acquisition of Cavendish, and actually a bit before, we're not just a broker. The brokerage arm is one part of the business. So what we are is about growth services to growth companies, and growth companies are those in the 20 to 500 million market cap space. And our vision is really to try and offer as many services as possible to those growth companies over time, and that's where we want to get to. So the ECM side, which is the bit you probably all know, we're the largest broker on AIM. We act for the largest number of clients on the London stock market, an average market cap of about 100 million. That's our ECM bit. Specialist PLC advisory we set up 2 years ago. That's all about bid advisory, whether it's hostile or not, advising someone on anything to do with PLC. Strategic advisory. Debt advisory, it's obviously the same debt solutions that we do alongside the equity side. Private growth capital, we raise money for unquoted businesses with revenue over £1 million. And Cavendish was our acquisition we made in December, which do M&A. Largely, they've been 30 years in the sell side space for mid-market companies. And we've started to do buy-side advisory since our acquisition. So that is the group. Where we think the market opportunity is, we've got the brokerages, which most of you will know, that are doing public market work and a little bit of advisory. And then we have the full M&A parties up here on the right that don't do any public markets. Where we thought there was a real point of difference, particularly in the growth space, is doing proper broking alongside really strong M&A. And that doesn't mean just a bit of advisory for your public market clients. It means proper sort of sell side, being able to run a process, being able to do proper buy side and do it very well and be able to compete with those in the top right. And we think putting those together makes us quite different from most other people in our space. And that's where we want to grow. We've got a 10-year history of building up a successful, profitable business. We've always been, touch wood, profitable. We've always invested in new bits of the business as we've gone through. And 2 years ago, we really decided to get into the private markets and the M&A space, largely because our ECM field is very competitive. It's actually quite a small market altogether. Lots of people vying for not much business. So we wanted to get into some growth markets, which we did. And then obviously the acquisition came with the real vision to try and own this growth space, to do lots of services for those core group of clients in the 20 to 500. So we're all about it being a trusted advisor to those companies, no nonsense valued advice, which we can deliver really fast. So that's our growth since 2008 when we did the buyout back here. And throughout that period, you can see there's a history of revenue and profitable growth. We've always invested each year, varying degrees, but significant throughout the period in different teams from a standing start. So our first acquisition in 20 years was Cavendish. Everything else has been organic growth. And so our plan, which we've recently presented to our staff and to our shareholders when we announced our first set of results in July, is how we're going to build this to a £100 million turnover business, which is our sort of short, medium term aim over the next 5 years. So we have at the moment 5% market share in the ECM business. We think we can grow that to 10. That's always been our aim. So doubling it from here. And that's really doing what we've done in the last 10 years again, which is acting for more active clients, slightly bigger clients, still in our core focus of the 20 to 500, and building up to what we've got. We've also launched investment companies a couple of years ago, which we think will be a significant part of that as well. So that gets us to a 10% market share. Then we've got Cavendish Sell-Side Advisory, which consistently does sort of 10, 11 million top line. We're looking to get that to a sustainable 20. In history, they've acted largely for entrepreneurs. We now can act for corporate clients as well as PE, which they haven't done before. And we're also introducing buy side. And we will do that by becoming very sector focused, which is what we are on the ECM side. And there's quite a lot of crossover between the two. Debt advisory of 5 million is our aim. The private unquoted bit, 5 million. So specialist PLC advisory, 5. And we're up to about 1.5 million as at the first half in that division. So that's gone very well. And then the balance is really what we might acquire, what we can build in terms of new teams over time, which could be regions, it could be other services into that same group of growth companies, and things we're looking at, sort of maybe accounting services, which are to the same group, but things which will diversify our revenue streams and make us more a professional services group than being seen as just a brokerage house that can just raise money for public market clients. So I'll hand over to Tom now to talk about our financials.
My name's Tom Hayward. I'm the CFO. I joined FinnCap 9 years ago. Before that, I was a chartered accountant and a fund manager. We have some information here on our inaugural set of annual figures. At the top here, it's quite important to understand these. We acquired Cavendish back in December, and therefore they only contributed 4 months to the figures we just announced. And then in order to align the year ends of the two sides of the business, the FinnCap business is actually only included in our numbers for 11 months. So if you now look at the first column here, this shows the FinnCap side of the business, and the Topco costs in the 11-month period generated just over £21 million worth of revenues and £3.5 million of pre-tax profit. The next two columns are on Cavendish. So the 8 months before we bought them, they had an extremely strong initial period, and they generated £11.5 million worth of revenue there. As Sam said, their normal run rate is somewhere between 10 and £11 million worth of revenue for a 12-month period. And then post-acquisition, £3.2 million worth of revenue, generating £800,000 of pre-tax profit. So if you put the two shaded columns together, you get the figures that we've announced recently. So £24.5 million on the top line and £4.3 million underneath that. Now, what isn't shown on here, because I didn't want to set expectations too highly, but if you were to normalise both sets of figures, so if you were to take FinnCap for 12 months and then take Cavendish for the full 12 months as well, including that super normal performance in the first half part of the year, you would end up with a combined performance of 38 million of revenue and pre-tax profits of just over £8 million. As I say, that reflects an abnormal performance from Cavendish. So here I break down that revenue into a little bit more detail. So on the FinnCap side of the business, if you look, we have just under £6 million worth of retainers. That's contracted revenue, notice periods. It is, we are signing up new retainers on a month-by-month basis. That revenue line has, generally speaking, only headed in one direction. We also have, we count it as a reliable revenue stream. There's no contractual basis to it, but our trading and research revenues is really relatively dependable. And if you put those two together, you'll see that we get 9.2 million of reliable, non-deal related revenues. In between them here, you have 4 different strains of transactional revenues. Now, they're separated out here to demonstrate the fact that we are not entirely dependent on the public fundraising markets. So we have just over £9 million worth of fundraising revenues. We have M&A advice for public market companies, bid defence, technical advisory of just over £1 million last year. And as Sam said, that continues to grow. And then on the private fundraising side, just over £300,000. That's an investment area we're working on at the moment. And then the investment companies team, which we brought on board about 2 years ago, it's a team of 5 individuals, just under £1.3 million worth of revenues. Then if you move over to Cavendish, if you combine the 2 different success fees before and after the transaction, you end up with just over £13 million worth of success fees and then £1.1 million worth of retainers. So when we sign up someone to sell their business, we always get them to pay a £50,000 retainer up front, just as a sign of commitment that they are actually intending to sell their business. The success fees are very much based on a minimum fee and then a ratchet for overperformance. And as I say, the £13 million there was a very strong performance over the period. The only other figure I was going to highlight on here is actually the smallest one on the page, is the debt revenues. Only £300,000 there. That has historically been Cavendish advising private equity funds on how they can fund an acquisition. But they have a great knowledge of the potential sources of debt, and we have 130 odd retained corporate clients who are looking for debt advice. So we've taken that team, we've recruited another 2 members into that team, and we see great potential for this figure in the coming years. If we go on to the next page, so a number of statistics here. To be honest, I was only going to focus on the ones you're probably most interested in. So the earnings per share, now these were quite distorted in the period by the costs of the acquisition and the transaction, the float. If you take those out, if you work on an adjusted figure here, we have earnings per share of 2.9 pence. And then if you compare that to our dividend per share of 1.4 pence, you can see that is well covered by the performance of the underlying business. And that 1.4 pence, we have a stated dividend policy of looking to pay at least a 5% yield on our float price of 28p. Now the share price at the close of business today, I think the mid-market price was 25.5p. So if we that 5% dividend yield on the float price is heading towards 6% on the current share price. Moving on to the rationale for the original transaction. The aim here, as Sam said, was to diversify our revenue base away from the 2 core pillars of the 2 separate sides of the business. So Cavendish sell-side advisory, historically, as Sam said, that's been selling private businesses owned by entrepreneurs. The opportunity here is to provide advice to our corporate clients, 130, as I said earlier on, 130 corporate clients, some of whom will want to sell themselves, some of whom will want to sell a division of themselves, and also to move to advising private equity on selling their portfolio companies as well. Then dual track, obviously the opportunity here is, whereas we previously have been offering our clients public market fundraisings and Cavendish have been looking to sell people, we can now offer a dual track process to anyone who approaches us, which is very useful. Now, on the debt advisory side, as I just said on the previous slide, the opportunity there is to advise our public market clients on how they can refinance their existing debt facilities. So we have 130 corporate clients. Of those, around about 80 of them already have an existing debt facility. So there is an opportunity there to go in and talk to them about refinancing that. The private growth capital, that's been done historically on the FinCap side. As I say, it's an investment area for us. But again, Cavendish clients will come to us and they'll say, yes, I'm interested in selling my business, but the alternative could be to raise extra private capital into it. So again, that offers us a new string to our bow there. And then the buy-side advisory. So Cavendish's previous branding was very much focused around being sell-side only. That's where their historic revenues come from. Under the FinCap umbrella, we are looking to offer buy-side advice as well. We have our first buy-side deal completed just before our year end, included in last year's figures, and we are talking to a number of potential opportunities there. The strapline, I think, that goes with all of this is that we have all these different services, and we can now offer all the different kinds of financing to all different types of companies. So we can talk to public companies, private companies about raising debt, raising equity, doing an IPO, or even selling themselves entirely. There aren't many people out there who can do that. And then Oaklands, as I said. So Oaklands is an association of the leading domestic mid-market M&A houses in 40 different countries. So 60 different offices, 40 different countries, 800 professionals. It really adds to your sales pitch when you go to see someone who's interested in selling their company, that you can then market that with a global reach. We have a dedicated member of staff who is focused both on advertising our transactions to the other members of the Oaklands network, and also then reviewing what they are advertising and seeing whether we have potential leads for that. It makes a big difference to our marketing pitch to our potential clients.
So early signs that the integration is working. Obviously, it's only been 9 months in, but we have won our first debt advisory mandate from one of our PLC clients and closed it, and we're working on quite a few others. I think Tom said there's 80 of our clients that have debt in them already to target. we think 40 are really good leads, of which we've already been to see 20. So there's really good uptake on that with a couple of new mandates signed. So that's going really well. We've closed our first buy-side role. We've won mandates for a couple of new buy-sides, and we're really working on that with PE. And we just appointed yesterday, he started a guy that's doing PE sponsor coverage. So that's a new area for us where someone will properly target PE and try and generate debt advisory and buy-side advisory out of that. Dual track, we've actually signed one of those up since then, and we're looking to sign up the second. But that dual track is really a good pitch. It's a USP where you can say to clients, look, it doesn't matter, you don't need to decide yet. We will run both processes and you can decide at the right point which one you go to. And actually, we've been able to win a deal that's much bigger than our normal size because of having that offering. So that's a good point of difference. Some crossovers of things that FinCap have introduced to Cavendish and vice versa, and then the debt side, we obviously recruited 2 people into that. So what we're trying to do as a strategy is diversify our revenue streams away from this just ECM. We still think there's good growth in that, although at the moment the market is difficult. And that's where the strategy is quite interesting, because we've been tested over the last 6 months of, when things are quiet, actually you can be quite busy on the other side. And that's meant, we've been much more protected on the downside. So that's good. The other thing is to go to the unique business model here. When you look at our fees, we had 85 different fees last year coming from FinCap clients and 28 from Cavendish. That's over 100 different transactions which we're doing for our clients every year. And that's fairly consistent year in, year out. And we keep trying to take on more clients that are active and that will do transactions. So we always hope a good percentage of our clients do something. So the average fee might not be massive, but because you're doing lots of transactions, it protects you very well on the downside, because generally people will do something. It doesn't have to be a fundraise, but it could be a transaction where you get some sort of advisory fee. So the number of deals that we're doing actually is what generates us good profitability, and has been the case for the last 10 years. So we're not about that one big deal, that one big IPO. So if the huge fundraisers aren't there, which they're not at the moment, we can still get to profitability by doing those small deals consistently well. So we're not reliant on any large fees. So we're all about broadening the revenue streams, really having this USP of quality broking with strong M&A. We've constantly invested in new teams and new divisions over the last 10 years successfully. We've always managed to get them to profitability relatively quickly and grow them. Investment companies and bid advisory are the most recent we've done. And then obviously debt is our current investment that we really hope that will start expanding in 12 months' time. So that is really the FinCap group. Have you got any questions?
I noticed that you've did about £1 million worth of revenue in Cavendish from retainers. So that suggests that 50,000 a pop, about 20 clients. But I think you've also said that the M&A side did 28 deals during the year. I just want to know how you reconcile those numbers.
So the new sign-ups on retainers are new mandates which generally don't get closed in the period. So the deals that get closed, a lot of the mandates might take over 12 months to complete. So things we're taking on now will probably close in 12 to 24 months' time, and some of them longer. So they pay a retainer as soon as they sign up, but that is the start of the process. So it isn't indicative of what will happen in the next 12 months.
Okay, that's very clear. Also, how do you as a firm deal with this challenge that we have as investors, that you have to look after the interests of labour? You've got talented people within your organisation on both sides of in the two companies, and how do you make sure that capital or investors are adequately remunerated both in good times, and how are they protected in bad times?
So we've always had a set policy of what is the bonus pool and what is the dividend policy, and that's continued since IPO. So because we've had a big staff ownership strategy from the beginning, we've always paid out a good yield. So there's always been a 50% bonus pot for the staff, and then we've paid out a good balance of the rest as dividend. Now we're public, we've set that at a 5% yield, and we want that to be a progressive dividend over time. So still 85% of our shares are owned by the team, so they are quite keen on their dividend, and that to remain. So that's just been how we've done things.
Can you just comment briefly on your business model in the private capital side of the business, and how maybe it'd be helpful to understand how that 318,000 is made up, and is that placement fees or?
Yes, so it's all raising money for unquoted businesses. As long as they're over 1 million revenue, we will look at them and we will raise upwards of 2 million. So they can be slightly bigger raises. We've done sort of 20 million pound raises, 30 million pound raises, and we will do 2 and 3 million pound raises. So the breakdown of that fee, I would have thought that's not more than 2 or 3 deals in that figure. So you're generally working on 20 at any one time, and you don't know in what year they fall. We started that 3 years ago. It took us a year to test the market, where we were looking at all sorts of companies. Well, that's where we said, look, we're not doing startup. It is a bit of a nightmare to scattergun. So we've tried to stick to, look, you have to have got to commercial traction. We have to know that we can find the investors and complete on the transaction. It just takes quite a long time to close. So that's only a couple of deals.
And how organised is the competitive threat in that business at the moment in the UK? Because I imagine it feels quite messy to me.
It's still, I'm not sure I'd describe it as messy, but it's a very unbrokered market. So the market's there. There's more being raised every quarter for private deals. So it's growing really fast, and the big ticket deals are growing each quarter. So there's more £50 million deals done privately now than there ever were before. So there's this huge wall of money. There's this huge need for companies to get advice, but no one has really cracked the brokerage of it yet. What we're trying to do is enter quite a new market of saying, look, we will find you the best money. We will match the right money to your vision. And that's really important because it will save you with problems later on. And that's starting to work, but not every company wants to pay for that. Our USP is really, we know many, many investors from high net worth family offices, our listed investors, which now look at private, to VCTs, all sorts of other different types of investors, and your normal PE. So our USP is we will talk to them all and we will tell you what's right for you, knowing what your vision is, and match it. But it is quite a new area to go out in and make money out of. And I don't think anyone has really cracked that yet. They're saying it's huge and it's exciting, but monetizing it, yes.
If I read the slide correctly, you had about 92 staff pre-acquisition, about 40 on the Cavendish side, and 108 combined. Did you lose some staff on the way through? Or?
No, we've got about 140 staff at the moment.
Okay, so maybe
it
it's
might
a
be an
weighted
accounting average because it's only there for 4 months.
Okay.
We haven't lost staff through Cavendish, no. It wasn't a cost-saving deal, it was a revenue synergy deal.
As a stock to hold, it's incredibly boring, isn't it? I mean, it doesn't move.
Well,
it doesn't
I
turn
don't
over.
think so.
Well, it's 15% free cap, isn't it? I mean, have you got any intentions of, sort of trying to free the market cap up a bit?
So when we did the listing, it was because it completed the Cavendish deal. So the reason we did it was that we wanted them to have equity. We didn't want to pay cash for it because it's a people business. And for them to take a large stock of equity in us, they needed it to be quoted. So it was the reason for the listing was to get it done and to fund it. So it's very limited free float. But once we've done it, we now think actually this is the way we can start growing the business. So I think for 12 months it's integrating the acquisition, but we are then going to use it to build new teams, make potential acquisitions, do other things. So we're not planning to sit here and just be like this forever. But I do recognise it as a start, it is a relatively illiquid share.
And also, when you do corporate deals, do you take some of the paper?
We do sometimes, but we don't do it as a matter of course. We're not a fund manager and we don't really want to be.
So, on the books.
Yeah, it's not to say we never do. The market making book, we will always take a small part as part of that market making situation. But as an investment, we like to take the fee, book the fee. Starting to be a fund manager gets very dangerous game.
I had a couple actually. I wanted to know, you mentioned about regional expansion, and I was wondering whether that was UK or overseas, and assuming it's mainly UK, does your membership of Oaklands in any way constrain what you can do overseas?
So the regional expansion would be UK, it wouldn't be overseas. So we're looking at areas where there are fast growth companies where we think they might want local advice, and I think the trend is to go back towards that way, that we will need regional advisors. So we're keen to do it in areas where there is a base of company. With Oaklands, You cannot be a member of Oaklands and buy something in the same territory and continue to be Oaklands in that area. You can buy something else and be another M&A house, but you couldn't put that into the Oaklands M&A piece
Can't be competing
where they
with
have that
existing
territory.
members. Sure. And then secondly, I know that providing debt advisory to quoted clients last cycle, some of the big banks made some quite sort of difficult choices and caused ructions with their client bases, both on the debt side and on the sort of the quoted side. How have you found the reception from your existing quoted base? Have they been receptive to the idea of a conversation?
Very, because most clients do want to talk to the same group. To go out to different advisors for different things is quite stressful when you're a busy CEO that doesn't want to spend all their time shopping around. So as long as you provide the service, you can provide competitive terms, and they're generally saving people a good amount by having things in bulk. So it's been quite an easy conversation where they want to have it. And weirdly, it's been, which we didn't quite expect, a really good pitch to non-corporate clients of ours where we go in on the debt because the current broker can't advise, and then you suddenly are offering something that no one else is, and then we win the brokership. So it's been a bit of a reverse broking as well.
Hi, I read occasionally comments from people like Katie Potts at Herald about the withdrawal almost of institutional investors from the very small end of the market. I was just wondering if you might be able to offer any commentary on how you saw it and where you thought things might end up.
So we have raised money from institutions and private client brokers and that community for 10 plus years. And some of the constituents change, but we've always found there's been quite a lot of money for quality deals. So we're still getting things away. I mean, there's clients that won't invest at the moment because of market sentiment, but it doesn't seem to be a problem of the money being there. The Woodford issue has slightly impacted some investors with small companies, but we haven't found that the wall of money has gone.
What's your sort of rate of loss of clients because they go to a different advisor from quoted clients?
So by rate, the percentage, generally over the last 5 years, so we've been the fastest growing broker for 10 years, but every year we lose clients. And it's partly, I mean, we look at, is it performance or is it because they've delisted, done an acquisition, or they might be too small and you're not able to service them anymore. So we look at the issues of performance. The performance churn is very, very low. It's in single digits every year, touch wood. So the others, the delistings, the acquisitions, we had a lot of takeouts last year, generally get quite high. So you will lose over 10% of your clients every year through a combination of everything. So we bank on that every year, which is why our new business, we have to win those clients back and more every year. So our target has always been to win over 20 clients each year, which we have consistently done over 11 years. And we are actually ahead of that this year. And when markets get difficult, we generally win quite a lot of clients, because when your service is your priority and you're there and you're committed to small companies, you generally find brokerships move.
You're not losing any clients because when they want to do a fundraising, you're not able to raise the amount of funds they want.
Not really, no. There might be a situation where you think, I don't think we can raise that for whatever reason, and that is part of, if someone else can, then great. There might be situations like that, but hopefully not where we're saying we can do it and then you fail.
Thank you very much indeed, Sam Smith and Tom Hayward. Thank you.